Hello, welcome to another edition of Nucleus Investment Insights. Today, I want to talk about NVIDIA. So it is basically the most important story in the market at the moment. And so we thought we'd do a bit of a deep dive into that today. So anyway, welcome to Nucleus Investment Insights. Each week we explore the trends shaping stock markets, currencies, commodities, global investment themes, giving you the insights you need to stay ahead. My name is Damien Klassen, Chief Investment Officer at Nucleus Wealth. I'll be hosting and sharing my insights and findings throughout the show. Don't forget to like and subscribe if you find our insights useful and you want more of them in your insight. Just a reminder that everything you hear today is general advice in nature. None of it is personal advice. If you do want to get personal advice, jump into the show notes and you can have a look how to contact us. Now, let's get into this week's show. So I'm going to start with the background behind this is that we have expensive markets, and given how expensive markets are, what we've seen over the last week is this pullback. There's this real fear around the NVIDIA release today. Is there going to be, if they disappoint, if there's going to be any disappointment, then could we see some pretty decent sized market tumbles? And we've seen stocks, a lot of the AI-based stocks are off a fair bit just in the last week on the back of I guess the fears that if it doesn't sort of meet expectations and exceed them, and so that's why we were sort of well worth digging into what's going on within this the NVIDIA report. Broad picture is look, the result was relatively good, and we do think there's it's sort of meeting expectations and increasing forecasts and things like that, and so we thought as well we're sort of digging into looking at some of the numbers behind it and just trying to work out what does it mean for the overall market, because really we have this two-speed economy in the US, or K-shaped economy, as people are talking about, with the idea that one side of the K is going up and the other side of the K is going down. And we're very much seeing from a lot of other companies, as you go through the reporting season, is they're talking about a consumer that is really not doing that well in the US. On the flip side, we have this rocket ship in AI, where every period was numbers are up, profits are up, everything's sort of going up. And so if you start to see cracks in that edifice and problems in the AI market, then your outlook for the overall market could be dramatically worse. And so that's sort of where we're sitting in terms of the AI, and I guess what we're trying to pitch, and why so much focus is on this one company and what they're doing. So I'll jump back into the slides just to sort of talk about the amount of money being spent by Microsoft, Amazon, Alphabet, Meta, and to a lesser extent Oracle. And so I've got a chart just showing up what their plans are for the next few years. So this year, sort of 400 billion-ish on data centers, looking to increase that to quite markedly into next year to sort of well over 500, and then again the year after and the year after. So lots of different, lots of growth forecast and planned from these companies, and that's sort of been affirmed. These companies have pretty much all reported, and so we know that money is coming through. We know that money's planned at the moment. So plans can always change, but at the moment, all these companies are poised to spend that money, and of that. Almost all of it is driven by cash that these companies are making. So I'll exclude Oracle because Oracle is going into debt for these, but of those companies you're looking at there, and keep in mind this is just 5 companies. There are other companies out also spending money in this space, doing similar capex. But of these 4 that are really the biggest, they're all cash flow positive. You might see that they're raising debt, but they're actually at the same time they've got equity as well. So it's sort of the part where they're raising say $100 billion worth of debt. They've actually got $100 billion worth of cash sitting on their balance sheet they could have used, but they're saving that for acquisitions and to buy back shares and other things like that. So in terms of have they got the cash to meet these? Yeah, they've got the cash to meet them. These companies. There are a bunch of other ones that don't, and I'll get into talking about those ones. But the real core of this boom, these main companies that are out there spending the money, is being done with cash. If you look at, say, a data center and what you're going to spend the money on, is 40% of it is going to go into the GPUs. So of that money we were seeing on that prior chart, these hundreds of billions of dollars, the bulk of that is going into buying GPUs within that, and very little of it is going elsewhere. And so what that means is that's why I guess we're so interested in NVIDIA, and why NVIDIA is the most the most highly valued company in the world, and what that actually means for them in terms of their profitability. So in a broad sense, pretty cracking numbers. Not a lot of, I don't think people could be too disappointed about. There might be sort of further comments that pop out that potentially are concerning, but all the comments so far from that we've seen from management and all the analyst meetings so far have all been pretty good for the outlook. As we're sort of, and I guess it's not a huge surprise in that we've seen all the companies come out that are doing the spending, and then and talking about their plans. So that as Microsoft and Meta and Google come out and talk about their spending plans, it sort of only flows through that yes, NVIDIA is also seeing things the same way. And I guess some of the real positives you're looking at is that, okay, so it's up dramatically on the prior year, but even just on the prior quarter, there's 20% growth, 22% growth just in revenue over that prior quarter, and that's sort of flowing through into the earnings as well. What is another positive, and what we're seeing in terms of the earnings is that I've put up the two different lines on this chart. One is the GAAP numbers at the top, and the other one's the non-GAAP numbers. And we can see from there that they're largely the same. So you're really not looking at much of a difference in terms of the numbers there. So your non-GAAP is actually slightly lower than the GAAP numbers for net income and things like that. So what does that actually mean, and why is that worth commenting on? There's a lot of other companies out there that report. So the GAAP earnings are your official numbers. These are the ones that there's accounting standards you have to apply to the accounting standards, and you don't have companies do have a reasonable amount of discretion about what they can do, but there's a lot of stuff they can't do within that. Then you get the non-GAAP numbers, which is where management come out and say, okay, we have our official way to look at it. Here's the way we think you should be looking at it, and they'll give you some non-GAAP numbers. And the types of things you might see in that is there might be some, say you've sold an asset, you've sold a building or something like that, and you made a profit on that. That might come through in your GAAP numbers, but you're saying, well, that's not an ongoing gain that I'm going to get. I had that building, I've sold it, I made this profit, or I've sold a division of my company, I made this one-off profit. So we should strip that out and look at the non-GAAP earnings. Now that's an example of a good way to do it, and a good way to, we like when we see those types of changes. There's lots of really dodgy ones that people will do where they'll say, for example, there's a pretty common ones, particularly in US tech stocks, is shares they've given to management, non-cash shares, and usually options. And what they'll do is they'll say, you should ignore these because they're not paying any cash. And the truth is, though, it's, you're not paying any cash, but you've just literally given away part of the company. You've taken it from shareholders and giving it to management. And there's companies out there where they will, you look at the GAAP numbers from the company, and they're literally loss making. And then you look at the way the company wants you to treat the numbers, and they'll be making some huge profit. And so, it's very much a do you believe management, in which case everything's fantastic and you're highly profitable, or you believe that the gap numbers and because of this, the amount of money that's been transferred, literally from management from shareholders across to management, is that the company ends up loss making. So, I spent a little bit of time on that, but what is positive about NVIDIA is they're not trying to dodgy the numbers up. And while there might be some issues, which we can talk about later in terms of some of the other companies within the sector and depreciation, which is a key issue sort of popping up, it's the numbers that you're getting out of NVIDIA really don't have a lot to be concerned about. Yes, I can be concerned about the growth. Will it come good? Will they be able to keep up this growth? Will they be able to keep growing the numbers and all that type of stuff like that? But the question about, are they genuinely actually making the profits that they're showing they're making, and are they genuinely getting the cash flow through that they're making, that they're saying is the answer is yes. You see the profits come through. They're not trying to dodgy the numbers up. You see the cash flows come through. The thing's just throwing off cash. You don't have as many concerns over that. So broad sense, all looks relatively good. I do want to jump in and talk more about some of the other major concerns that are circling at the moment, and we'll do that just after this quick message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so there's been a lot, in particular there's a famous short seller, Michael Burry, from a famous short seller from the financial crisis, talking about there being a bubble and talking about quite vocally going short Palantir and NVIDIA. Now, the Palantir one I have a lot of sympathy for. I do think there's that stock is just really, really expensive. One of the things he's been talking about with NVIDIA is the issue about depreciation of the chips. And effectively what he's saying is that these chips just aren't worth what they're what they say they're worth. So the problem is that the chips are the problem with the chips is that they're depreciating faster than what companies are booking them, and so all these other companies, Microsoft and Google and Meta and everything like that, should be reporting much lower profits because they're basically buying chips for, say, $100 billion. Mostly they're depreciating it over 5 or 6 years. And what they should, so you spend $100 billion in chips, you should be writing off, say, if you're doing it over 5 years, $20 billion per year. What Michael's saying is it actually should be $33 billion per year because the depreciation rates are much higher. And so the profits they're going to report are going to be way lower. Now, there's a lot of conjecture about this. There's companies that are doing it on 6 years. CoreWeave in particular is one of the main ones doing it there, and they talk about being very comfortable. They talk about the rates they're getting and why they're using those. I do want to note for a lot of these these same companies had 3 or 4 years. So if you go back to the pre-2020, a lot of them were depreciating over 3 or 4 years, and they actually were started extending the life out in their accounting standards. So they've been reporting some better numbers because they've been changing how they've been reporting. But the reason why they're changing their reporting is because they're saying, well, yes, we're depreciating it over 4 years, but we're finding that the computers are actually lasting us 5, 6, 7, 8 years, and so we've been extending it to cater for that fact. Now, how much have we got to how much realism is there behind this? Well, I just want to show you some numbers, some rental numbers that you're getting at the moment where if you're renting cutting-edge NVIDIA chips, there's been some reasonable falls in what you can lease them out for. So we've got these H100s, and then you've got the A100s. Now I'm going to focus on the A100s. It has come down a lot over the over this. It's sort of down about a third over the year. But in my view, a lot of that is the it's the how hot we were seeing the market earlier on, as opposed to this being a major issue in terms of it was the pricing earlier on this year was way higher than expected rather than a concern. So our rough numbers go, if you're buying a H100, it's probably costing you about $1 per GPU hour. So yeah, you're not getting great return. You're not getting as good returns as you were at the start of 2025 when you were getting, say, $3 an hour. So you're getting like triple. So costing you $1, you were getting back $3 to rent it out. Now you're only getting back $2. So some concern over that, obviously, but it's still pretty healthy returns on. You're getting 100% markup on what your costs are. Of more interest, say, is this A100. Now, the A100 were released about 5 years ago. So we're talking about a chip that is 5 years old. Our rough thoughts on the cost of these is probably more like 50 to 70 cents per GPU hour that it costs you in terms of buying. So the thing's 5 years old. You're still making a pretty reasonable profit on renting it out as at today. And so, I guess the net effect of that is, well, if I can still sell a 5-year chip and still make a 20, 30, 40% markup on what I bought it for 5 years ago, it's fine as a depreciation. Like it obviously hasn't got a 3-year depreciation period if that's what you can rent it out at. Now, is that true of every single chip? But do they have problems with some of them won't be working as well as what they used to? The speeds won't be as good. Yeah, there's all these other issues that go around it. Will we suddenly get a new release of chips come out where the new release of chips is so good that these old ones all of a sudden get marked down and there's less interest in them and all that? Yeah, there's maybe. But I think as a broad sense, there's this concern around depreciation that I think is doesn't have a lot to support it in the background. Maybe things will change and there'll be issues with it, but as far as what we can see is the demand is so high for these loads still that the chips are still needed. If demand starts falling off, absolutely, they might have to ramp up the depreciation on these. But given where we are at the moment, where the demand for new data centers is high. The people who are building the data centers can't build them fast enough for the demand they're getting from corporates. There is certainly this, it's. I don't want to say there's nothing behind these allegations and the suggestions that the whole thing could come unraveled, but there's just not a lot of support in the active market. It's all about a forecast of saying, yeah, demand's really strong at the moment, but it's going to fall off a cliff in 6 months' time or 12 months' time, whenever everyone all of a sudden comes to the realization that this AI stuff isn't working and I'm wasting my money, and so I need to, all these companies all of a sudden start to slow down their spending on it. Within the companies that we're seeing report, other companies outside the AI sector, really there's two parts to the themes that we see that relate to the AI parties. One is the US consumer's quite weak, and there's its own concerns around that. But the second part is none of them are cutting back on their AI spending at the moment. Very rarely do you see companies talk about bad things within that. It generally tends to be saying, okay, AI is doing some things, we're spending money there, we've got things out. Maybe they haven't got a great return on the spend they've done so far, but companies are genuinely seeing either real life examples of productivity gains, or they're seeing where this can take it. It might not be there at the moment, but I don't know, pick your industry. So I'll use DoorDash, this delivery industry. The delivery robots, they may not be there, may not be working at the levels that they want, but they can see the technology and they can see where the AI is taking it, and the idea that if they're not spending money, then somebody else will be, and it might in a couple of years' time they might find that they don't have a business anymore if they if their competitor gets it right. And so it's a very brave company at the moment that's going to say, yes, my competitors are all spending money on AI, but I'm not going to because, I'm taking the view that AI is a bust and it's never going to work. So that's generally what we're seeing from companies. The other concern that people have is around this idea that there's a real interconnectedness within the spending that could just bring down the entire sector. And there is some truth to this. I've just got a chart up showing the interconnectedness behind, and it's mainly OpenAI. And the idea is that OpenAI is funded by companies. They're then demanding. They're then out, putting out big contracts for places like CoreWeave or Oracle or Microsoft to spend money and lease data centers. And so it's effectively, well, I'll use the NVIDIA one. It's probably the most circular one, where NVIDIA gives $100 billion to OpenAI, who then gives a $300 billion contract to Oracle, who then go back and buy, $40-50 billion worth of chips from NVIDIA. And so it's this idea, but that and that's just in a 1 year period, and they might do it again over multiple years going forward. And so it's the idea that yes, OpenAI is, if OpenAI comes unstuck, then this whole thing could unravel. And there's certainly truth behind that. So if capital markets close, if OpenAI can't raise money, then there's a whole bunch of these deals that have been done that will unravel behind that. Would the entire sector come undone? Well, no, I don't think so. There's certainly, we saw how much money these other companies were spending. We're talking, $500 billion moving up to $1 trillion. OpenAI might, that's per annum. OpenAI might be $50 to $100 billion of that. So it's quite a sizable chunk of it that is being. But they're not the only one with demand out there. It's not the only one doing this. If you saw that it was a flow-on effect of loss of confidence in the sector. So lots of confidence. Nobody's going to give out OpenAI. OpenAI can't raise money in order to build the data centers in order to do what it's doing. Other companies can't raise money to set up their own. You get Anthropic and other ones that are trying to build similar AI engines. If they can't raise money as well, if you see Google and Microsoft all of a sudden starting to pull back on what they're spending, and saying, we're not going to throw more, or Google's not going to throw more money into its own one. Meta's not going to spend more on the Llama. If you see all those type of stuff, yes, there's real concerns, and that whole thing could certainly come unwound. But the flip side is, if it lasts for another 2 or 3 years, then a lot of these players that are debt funding it, and Oracle I'll take as one example in particular, will generate enough cash flows to mostly pay down most of the debt. So if it all finishes in 6 or 12 months, Oracle's got some serious problems. It's ramped up all this debt. OpenAI falls over and can't raise the capital, and so can't meet its obligations to spend all this money. And Oracle's spent this money on data centers and hasn't got any tenants and problems like that. Yeah, there's some serious problems for them. But if you go 2 or 3 years, they're spinning off enough cash to pay off the debt that all of a sudden that's nowhere near as an issue. So interconnectedness, certainly a problem, and it is reminiscent of the problems that you would see in a bubble and the whole thing coming unwound. But to me, it still looks early days. It would take an exogenous shock really to bring this down, and quite a different outlook than what we're seeing at the moment. So yeah, something to keep an eye on, but I think for current purposes, not really something to be wildly concerned about. Okay, so that's some of the quick overviews. I want to jump into a little bit more some of the other factors that are facing facing NVIDIA, and then we want to go to the investment outlook upon these. So some of the other factors I want to talk about, probably slowing the geopolitics side of it. So that's another, really not a lot of movement in terms of what's happening in China. Potential upside there. So maybe some of these older chips they can start selling into China. The question is, does China want them? China's desperately trying to get its own semiconductor industry up and running. It is behind it's going to be very hard to catch up. The US is doing a fair bit to slow the wheels on China's semiconductor industry and preventing technology transfers. I think there is still scope that NVIDIA will start to sell something into China, and so that's something worth watching. Some potential upside. Not a lot of. I don't think there's much more potential downside you can see from that, given that really there's and as they confirm here, they're really just not doing that much in China at the moment. In terms of the what was the other one I wanted to talk about there? Profits, competition. The other one's competition. So AMD's got some interesting chips out. Google's got some interesting chips out. There's certainly something to keep an eye on for NVIDIA within that. AWS as well. So there's definitely things going on within there that is worth considering that, and keeping an eye on the competitors. At the moment, none of the competitors are at the stage where they're taking meaningful market share from NVIDIA. It still has sort of 90% plus within this area. So that could certainly fall back. But given the demand and how fast everyone's trying to do things, it puts NVIDIA in the driver's seat at the moment. And given their sort of lead on their competitors, there's not as many concerns, but certainly another area. Oh, sorry, no imminent concerns over big losses in market share, but certainly something to keep an eye on. And possibly for some people, it's a strategy of saying, well, maybe you take a bit of an offsetting bet on this, and you get some Google, you get some AWS, maybe you get some AMD as well to take the view that, well, if NVIDIA loses market share, it's going to be to one of those three other players most likely, and so therefore, what you lose on one, you'll make up on the other. From that perspective. So yes, I do want to talk a lot more about the investment side, but I'll come back after this message to talk more about the investments.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So I wanted to talk, just talk a little bit about NVIDIA from where do we see some of the value? What are we seeing within some of the numbers within this? And so where does it look as at the latest? So the way we tend to look at companies is on this value versus quality matrix. And so the idea, what we're trying to do is put I've got this chart showing up here, but basically on the y-axis we have good quality through to poor quality, and then on the x-axis we have cheap through to expensive, and we're trying to buy stuff that's sort of under the curve, so to speak. So NVIDIA, depending upon, and there's all these different time frames you can look upon this. There's all these different factors we can look at, but in a broad sense, what we're saying is NVIDIA is sitting right on the highest quality side, just in terms of the upgrades and the earnings and all that type of stuff like that. I'll jump a little bit into some of the factors where they don't look as good in a sec. But the valuation is certainly not cheap. It's at sort of 80th percentile, roughly, in terms of valuation from our view. But it looks better the further forward you look. And so it really is a question about, are the forecasts maintainable? The best chart for NVIDIA is the one I've got showing up here at the moment, which is their earnings per share for the next 12 months. Now, this doesn't incorporate today's earnings. We still yet to see earnings forecasts and what they do after the results. But what I really want to highlight with this graph is the blue line is the next 12 months earnings, and the upgrades just come quarter after quarter after quarter. It's been pretty much a 45-degree straight line. And what we've seen just in the last month, we've just seen, say, to next year's earnings, we've just seen upgrades already from $7.50 it was a month ago. They're already looking at $8.58. So you've just sort of seen a dollar worth of upgrades to earnings just in the last month. There's going to be a few more upgrades following today's result as well, I suspect. So yeah, it's just that's the key line. Once that line stops rising, once you actually start seeing downgrades within that, then there's concerns. But the earnings upgrades are still just talking about almost doubling in profits for this. And so what does that mean in terms of the numbers that you're looking at? So your price to earnings ratio, 29 times. After today, it'll be over 30. But that second year out, then you're falling right back to 22 times. So NVIDIA is a company, it's in a nasty industry. So and what do I mean by that is that the companies within this industry, companies like Intel, Texas Instruments, all these semiconductor companies that have been the leaders over the years, and then have fallen back. And you're only as good as your latest hit. Nobody really cares that much about brands as well. What tends to happen for companies within this sector is, the more mature companies, once you hit that level of you've reached a steady state and your earnings are just rising with the sector, is they'll trade on a pretty big discount to the market. So usually in that sort of 10 to 15 times earnings range. For companies that are the leaders in this industry, but have reached sort of a more mature phase. Now, NVIDIA is not at that mature phase yet. They're still growing these things rapidly. So you're talking about saying, oh, look, they're 22 times, not next year's earnings, but the year out, based on current growth. If they can grow again at the same rate one more time, now you're back to that 15 times earnings. So if you get 3 to 4 years worth of, that 25, 30% growth in terms of earnings, it's back to a pretty reasonable multiple. If they traded on that in the longer term, you'd be like, fine. If you get 5 years of that good growth and then maybe they lose some market share and the earnings fall a bit, you sort of still come back to about the right numbers. So NVIDIA, is it expensive? Yeah, it's a little bit expensive. Certainly on last year's numbers, but even on today's, it's a little bit expensive. But it's 20 or 30% more expensive than the market for a company that's just ripping their earnings. And so, does it look terrible? No, it looks like if you're going to say what company am I prepared to pay 30 times earnings for? Well, it's a type of company that's ripping in these fantastic growth numbers year after year. And that real question is, when does it stop? If it stops next year, the company's way overpriced. It's probably going to fall back by 30, 40%. If it takes 5 years before its earnings sort of revert back to a more normal level, then there's a pretty reasonable argument for buying the stock still at current prices. So yeah, it really comes back to your view on that. What else do we have in terms of numbers? If you're looking at, we use some of these acronyms will be a bit harder to see, but the bottom one's another interesting one is the free cash flow to equity. And you're looking at sort of next 12-month numbers of 35 times next year and back to 27. So free cash flow doesn't look as good as the earnings, but it's still pretty reasonable given the amount of spending that's going on. Debt. No, there's no debt within the company. So you're talking about a company that's net cash. So really no real concerns over that. And you're looking at some pretty significant profit forecasts that are expected to come through. But, a lot of those are sort of, it's booked, booked revenues and Where do we see some signs? So if we look through some of our quality metrics and say, well, what are the things you might be a bit concerned about? Well, the price stability it looks poor on that measure. that's the share price is volatile. The earnings stability looks a little bit negative in terms of earnings stability, but that's understated that's more of a measure of it's been growing so quickly that depending upon how we measure it, we measure it a whole bunch of different ways, is that sometimes companies that are growing really quickly can look poor on that measure. It's, I guess, the factor is it's the good type of earnings stability that it keeps outperforming on the upside. And then in terms of value, we sort of rank up 4 or 5 different ways. Some of them, there's a couple of hundred ways we do in the background, but 4 or 5 overall ones. But yeah, its value versus its industry looks, it's at the 80th percentile. Again, that's pretty good given the growth rates they've got, and talking about being one of the better ones. Value versus market is sort of at the 90th percentile. Its value versus its own history actually looks pretty reasonable. I'll jump to a chart just sort of showing where those come from. So this is sort of like the last 25 years of its value, where it sits. And this is just a percentile rank where, when it's trading at 100%, that's where it's one of the most expensive stocks in the market, and when it's trading right at the bottom. And so what we've been seeing is, for the last decade, it's sort of been trading at the 99th percentile, 98th, 99th percentile. It's back at the 82nd percentile at the moment. So not to say that, it means that's where it should always trade, but it's certainly, relative to where it's traded in the last decade, it doesn't look expensive. It does look expensive if you start looking versus other companies or versus the market. And certainly some of these are based on historical measures. And so on a historical measure basis, it looks worse. So if we did like an adjusted value, it's more like the 94th percentile, but if we look at the forward value, it's on the 76th percentile of the forward value. So yeah, really, it really does come back to a question of how does it sit versus how reasonable is it that the profit's going to come through. Other thing I wanted to highlight for this is let me come back to that presentation. Is that there's a couple of different ways you can interact with NVIDIA within our framework. So one way is if you want to just get rid of some of the AI stocks from your portfolio, you're happy. We've had a few people who have been taking profits on some of these. You can just screen them out and say, look, I don't want AI stocks within my portfolio, and cut that out. You can also do custom screens and literally just take out the stocks you're not interested in. Within that. And then for those though who are looking for the extra exposure, you can, so within our portfolios there's the idea that you can screen stuff out, you can add more of things in that you like, and within those, large tech stocks, cloud computing, AI, all get you exposure to that industry and extra exposure if that's what you're looking for within your portfolio. So yeah, so net effect of all that, result looked pretty good. We've seen all the other companies come out, or pretty much all the other major companies in the sector come out and talk about their CapEx plans, really reiterate their CapEx plans. Shaky market for most of the start of this week, with the idea that, look, NVIDIA is about to report. Is there going to be some concerns over that and what they're saying? From what we've seen, all looks pretty good again from the NVIDIA front. Will this be a chance for people to be, will we still continue to see a volatile market in NVIDIA? Absolutely. It's to see a 5% movement in NVIDIA up or down in one day is pretty typical within that. But in a big picture sense, it's certainly expensive if you're looking at last year's numbers. If you're looking at next year's numbers, it's a little bit expensive. If you start going 2 or 3 years out, it comes back to be something much more reasonable. It's really a factor about if you do have concern the AI boom is finishing very soon, it looks expensive, and you might want to be getting out. If you sort of more on our take is that, look, this AI boom does look like it's got legs. We in a way, the weak US consumer and the rest of the weak economics within the US is sort of opening up and leaving more room for the AI boom to continue. Is that it's going to be hard to find growth in other parts of the market, and there's still some reason to stick with the AI stocks until we see more things that are concerning. Anyway, that was all I had to comment. We haven't had a lot of comments through today, but thanks a lot for listening in. I do want to highlight for everyone that, if you have found today's insights helpful, give us a like and subscribe so you don't miss any future episodes. If you've got any questions, you can leave them in the comments. We'll answer them on our socials. Don't forget to catch us live for the next episode, next Thursday, 12:30 Australian time. For more insights, visit our website or sign up for our weekly email to get updates straight into your inbox. And if you'd like to build a personalized investment portfolio, head over to our website to start your risk-free account, send us an email, book a free consultation call with our team. On the website, we've got a QR code. You can jump in and catch us on all the major podcast platforms, and look forward to hearing and seeing everyone next week. Thanks.